As you continue to examine the balance sheet, you notice different elements in different categories. Under non-current assets, you find property, plants, and equipment, and other non-current assets. Within current assets, you see cash and cash equivalents, accounts receivable, inventory, and other current assets. Under equity, you notice share capital and reserve and surplus. Within long-term liabilities, there are long-term loans and other long-term liabilities. Finally, under current liabilities, you see trade payables and other current liabilities and provisions. Some of these elements are familiar to you, while others are completely new. You have heard of terms like cash, loan, receivable, and inventory before, but terms like retained earnings, cash equivalents, other current assets, and other current liabilities are completely new to you. Your mind is buzzing with questions. What does each of these elements mean in accounting terms? Why are they classified this way? Is cash in a business the same as the cash you think of in daily life? And what exactly are cash equivalents? You know that receivables mean money owed. But is it the same as when a friend owes you money for dinner? To you, inventory always meant a list of items, like the list of grocery items your mom gave you for weekly shopping. Does inventory have the same meaning in the context of a business? Do business loans have a different meaning and structure compared to personal loans? What does retained earnings mean? Why is it in the equity section? What exactly are other current assets and other current liabilities? Your mind is filled with all these queries. Lisa notices your confusion and steps in to help. Let's see what Lisa has to say about them. As per Lisa, the share capital, also known as original investment, is the amount of money that the owners or shareholders have invested in the business. It's the initial funding provided to start and grow the supermarket. For Sunshine Supermarket, each shareholder invested $100,000, totaling $300,000. This money allowed the supermarket to buy its first inventory, equipment, and cover initial costs. Understanding paid-up capital is crucial because it shows the financial foundation of the business and the level of risk the owners are willing to take. Retained earnings represent the portion of net profit that is kept in the business rather than being distributed to shareholders as dividends. This money is used to reinvest in the business, fund new projects, or pay off debt. Retained earnings are different from simply profits. They are the accumulated earnings that are reinvested back into the business over time. Retained earnings are listed in the equity section because they represent the shareholders' claim on the profits that have been reinvested in the business. Sunshine Supermarket shows retained earnings of $278,172. It increases when the business earns a profit and decreases when the business incurs a loss or pays dividends to shareholders.